Okay, so good morning, everyone, and thanks for everyone who's watching. We are joined today with Lillian and myself on live on YouTube. We'll be talking about a couple of different things around how people can take the best advantage and be ready for, I guess, future opportunities based on the current budget that was released by the federal government 2 weeks ago. So today we want to specifically talk about three things. One of them, the most important one, is understanding how SMSFs actually work. A lot of people on my channel have been inquiring about buying property through their super fund, looking at commercial and residential property through their super, and looking at other options such as trusts or companies to help them continue buying property. They also need keen to understand the tax implications of things, so we can briefly cover that off as well. That's going to be the main part of our conversation. Also, just the second part of it is how borrowers can actually navigate through this high interest environment. As you know, obviously the rates are probably the highest that they've ever been, and since, I guess, in the last couple of years, and people are looking at ways on how they can reduce their commitments and what they can do to continue making their repayments without having to impact their ability for future borrowing and things like that. So we'll cover that off as well. And we're also looking to talk about something exciting, which is commercial property lending. So a lot of people on my channel have recently reached out inquiring about how they can actually get into commercial. They've got an established portfolio of 4, 5, 6 residential properties, and they're looking to now not focusing anymore on the negative gearing component, but actually looking at income producing assets with a higher yield, for example, a commercial asset. So we'll be talking about all of that, and hopefully, you can get some value out of today's presentation. What I'll do is I'm just going to share my screen to talk to you about self-managed super fund as a starting point.
Sorry, Naveen. Would you mind just do a quick introduction about yourself and
yes.
your experience? Yeah.
Of course, yes. Okay, so I'm Naveen Merani. I'm the mortgage broker and managing director at Your Finance Network, which is this company here. My wife started the business about 3.5, 4 years ago, and I joined her in July last year. Prior to that, I was in Westpac for around 12 years in private banking, commercial lending. Also, I was doing a lot of the business development for brokers to help them understand how to write loans. So that was for about 12 years. And then before that, I was with CBA in business banking and merchants team looking after small businesses. So I've been in banking and finance for just around 2 decades. I was with American Express, car leasing companies and all that sort of stuff as well. And I also have an accounting background as well. So I'm pretty much all finance, and that's basically what we do here at Your Finance Network. So yeah, I hope that was good, Lillian.
Thank you. Yeah, and it is working on my Facebook group now.
Okay, great. Yeah, I think we have to live with the technology sometimes. It is what it is.
Yeah.
So thank you for the opportunity, Lillian, today. I think it's really good to be part of this community and share some important information that we are receiving and inquiries that I'm getting from clients after the budget,
Yes, wonderful. And just let you know, our group is focused on property investment in Australia. And it contains a lot of local as well as overseas members.
Oh, great. Okay, lovely. Fantastic. So I think in terms of investment...
Oh, sorry. Yep. You go.
No, you go. What were you going to say?
No, I just thought, just waiting for you to dig into the super fund home loan for us.
Yeah, exactly. I was going to do that next. So I think a lot of people are inquiring about SMSF loans. So I'm going to share my screen, and it's basically, we'll do it as we go so that people can see what we're looking to discuss. Is my Excel spreadsheet coming up?
Yes.
Okay, great. So
can you see?
Yeah, I can see it now. Yep, it's
Okay,
coming
great.
up as well on my screen. So what is a self-managed super fund? So everyone who's currently working either as a PAYG or even self-employed pay themselves a super. So generally, if you're working as PAYG, you have something called employer super contribution, which is roughly around 12.5% of which is roughly around 12.5% of your income. So let's say if you're on $100,000, let's say if you're on $100,000, your employer will technically be paying you around $12,500 in super contributions, which is spread over every pay cycle that you receive, and that's going to be yearly. Now, most people they don't technically think about this too much, and they don't technically focus on this because they basically focus on their main income that they take home, which is your after-tax money that comes into your account that can be used to buy property, to buy commercial assets, to buy other investments, cryptocurrency, and all that sort of stuff. But the biggest, like a very large pool of funds that people have available to them is their self-managed super fund. For anyone who's been working for more than 10, 15 years, they'd have close to maybe $180,000 to $200,000 in super. That's a very, very strong superannuation balance that people have available that they can use to buy property. So how it works is right now, let's say, for example, I'll give you a comparison. So if you've got something called an industry fund, let's say Oz Super or something like that, for example, and they're investing, and your current super balance is, let's say, 200,000, and they're investing that in the current market, they might be getting you between 4% to 6% return on that every year. So that works out to be, let's just say 6%. So let's say 200,000 times 6%. Every year, you're receiving around $12,000 on your $200,000 superannuation fund balance that's being received to you. Then they charge something called what's it called, like a investment management expense. So because they're managing your super, they will be charging you anywhere between 1 to sort of 3%, depending on how large the super balance is. So let's say 1%. Okay, so 1% would roughly be $1,200 goes into management expenses. So you may maybe get in your hand 1,200 minus, sorry, 12,000 minus 1,200. You get around $10,800 come to your account every year based on the market. Could be up or down, but that's basically what you'll be receiving every year that goes into your super fund and continues to add to the balance and grow. That's the traditional way to do it. Now, as you may probably already know and have seen in the news, there's been instances where superannuation funds go bust. People lose their savings. They also have issues where people, potentially invest in the super fund, and they're not sure what they're being charged. They're not sure what the actual investments are. It's a very passive sort of investment. So there's different sorts of investments like growth, high growth, low growth, no risk averse and things like that. So there's a lot of different investments that that super funds currently invest in, but the chances are people that are going through an industry fund don't necessarily know what they're investing in. So as a starting point for anyone who's looking to buy a property through super, first thing, most important, is to actually look at your current super fund, find out what is the current balance, how much do you actually have. What is your current investments? Is it high growth? Is it low growth? What are you actually invested in? What has been your return in your super fund over the last 5 years? And how much are you paying? What are the costs for your fund manager? So you can get a statement that gives you this information. As a starting point, the most important aspect is to understand what that actually is, okay, before you even think about self-managed super fund. And if you find that you want to explore other options like self-managed super fund lending, at that point in time, you can definitely explore that option through a sorry, I'm just going to change that, through like a financial advisor or a financial planner or an accountant who can help you set up the self-managed super fund. So once you set up if you do end up going down the path of a self-managed super fund, we recommend a minimum super balance of $200,000 to buy a residential property. Anything less than that just means that you'll be buying a very low quality asset. It's not going to be on like one of the best possible assets that is for your super fund. So that's the minimum investments. Now, there are some rules with self-managed super fund. Number one, it has to be investment only. You cannot live in the property. So that's definitely out of the question. So it has to be an investment property only, and it has to be the best intention for your super. Because this is money for your retirement, you have to make sure that you buy a property that is going to help you grow your super fund balance by the time you retire, so that you can actually use that as your retirement money. The number 3 is that you cannot build on it with borrowed money. So let's say, for example, you want to buy a house and land package. You can't do that through a super fund. Let's say, for example, you want to buy a property, and then later on you want to get equity from that property to build a granny flat or buy another property. You cannot do that with your self-managed super fund, because it is governed by something called the SIS Act. And the SIS Act is basically going to be dictating what your super fund can and can't do. You get audited every year, and you have to make sure that it's compliant. So that's very, very important, that you know that there are certain things that are not available. Like, you cannot live in the property. It has to be investment. It has to be the best investment for your super fund. You cannot build on borrowed money. But outside of that, it's amazing as an amazing investment option.
Sorry, Naveen, I just want to clarify. So, buying land and doing a building loan, and buying that sort of house and land package in the super fund is not allowed. How about a brand new, already completed, brand new property? Can you buy that?
Yeah, so we've done that before, Lillian. So, for example, house and land package is not allowed, because house and land package requires progress payments, and that's not actually allowed through the self-managed super fund. However, some builders will say, give us a $10,000 deposit and pay us the full money when the building is completed, and that's all you need to do. So there's no progress payments. That's fine. As long as you have $10,000 in your self-managed super fund, you can go ahead and put that deposit. Make sure you speak to a broker who can actually calculate the borrowing capacity and in your super fund to give you some sort of a comfort, but that's perfectly fine. The other way, that if it's a brand new build, absolutely, that's perfectly fine, as long as there's no progress payments or a construction period in the self-managed super fund where the bank needs to make payments for the builder to continue building.
Okay, got it. Thank you.
Yeah, no problem. So yeah, that's a great question. Thank you for asking that, actually. So basically, when you do go down the path of buying a property through super, how did the bank actually look at it, right? So the first thing that so from the bank's view, banks looks at, number 1, what is your employer contribution, okay? This is your standard employer contribution of 12.5%, okay? Then the next thing is, how much is the rental yield you're receiving? Now, Lillian, what is the current rental yield you're seeing in the market on residential? Is it around 3-4%?
Yeah, for traditional house, high 3s to 5%. Yeah.
So let's say 4% to 5%. Okay.
Yes.
So we work on those figures. Okay. So that's the rental yield on a property. So essentially, what that means is, if you buy a $750,000 property, you're looking at around. Oops, sorry. You're looking at around $30,000 of income in rent every year, roughly. Okay. Then you've also got your employer super contribution. So let's say you're on $100,000 a year. Your employer's contributing $12,500. So this is all that is required to verify whether you can actually borrow to buy the property or not. Okay. Now, if you have got debt outside of super, for example, home loan, investment loan, credit card, car loan, HEX debt, what's it called? Like buy now, zip pay, zip pay and things like that. It doesn't matter. None of that is important, because the bank only looks at your employer super contribution and rental yield. Those are the two main drivers. We start from there and then we work up. Okay. So let's say, based on this, you can't actually borrow to buy a property for $750, because it's actually on the lower end. So what else can you use to borrow more to buy for $750,000? Because technically, $42,500 every year isn't enough to service a loan of 80% against $750,000. So $600,000 loan, it doesn't actually work out. So what can we actually use to hit that $600,000 mark? Okay, so there are two main sources of contribution in your super. One of them is called concessional untaxed. Now, this is basically $30,000 that can be contributed to your super every year. So let's say, for example, your employer is contributing $12,500. You can put an extra $17,500 additional into your super fund every year, and the lender can actually use that income for servicing. So now instead of 12.5, we're talking 30,000 plus 30,000. So we're talking around $60,000 of super contribution. Sorry, $30,000 of super contribution plus $30,000 of rent, making it $60,000 of income to service a loan of $600,000, which is 80% of $750K. Okay. Now, if that is still not enough and we need to borrow more, now what we can do is look at other options. So there are lenders that would look at taxed. So they will look at non-concessional taxed contribution. So this is $120,000 every year that you can put into your super fund. So how does this work? So basically, the first one is your before tax dollars. So every month, if you get in your account $5,000 of income into your account, the super fund contribution goes to your super fund, your current industry fund, before that $5,000 come to your account. So that's before tax money, and that's already automatically concessionally untaxed contribution into your super fund. Then there's non-concessional taxed. So you can actually contribute up to $120,000 of your own cash into the super fund every year. This income is already taxed. So this is money that's already been taxed, and you can actually contribute that into your super fund. So together, you can potentially contribute $150,000 every year in your super fund, in your self-managed super fund, to buy things like property, shares, other investment options that could be, you know, gold, silver, whatever tickles your investment strategies, right? So we're talking about $150,000 of combined contribution plus the rental income if you're going to buy property to help boost up your borrowing capacity. Does that sound? Am I going too fast, Lillian? Is that something that maybe?
No. Yeah, it's very, very good. I love that you broke all this down. Yeah, for borrowers to understand. This is very helpful. Keep going. Keep going. Thank you.
Great. Okay. So I'll give you an example, right? I had a client who came to us, and I've got it sitting here, right? So I've got a client who came to us. They were self-employed. They were earning 100K income. They have a 160K super balance. The wife was PAYG. She was earning 80K, and she had 120K super balance. So the total super they had was equal to 160 plus 120 in their account. Okay. And this money was being invested in the industry fund. They had no idea what this was invested in. They just thought that it's just sitting there. They don't really know about it. It's just going to be one day mature and give them some good return. And, and then, they ended up seeing one of the YouTube videos that I did on SMSF, and they contacted me and we broke it down. We got an accountant to have a chat with them as well and explain how this works, right? So they've got 2 kids. They've got a $10,000 credit card. They've got a principal place of residence, which is currently a market value of $1.5 million with a loan of 500K. They've got an investment property with a market value of 850 and 80% loan on interest only. And these are the current monthly commitments. So based on this, they were looking to get into the property market through their super. What we were able to do is we were able to help them set up a self-managed super fund. Now, once you set up the self-managed super fund, you don't transfer all of your super balance straight away into your self-managed super fund. And the reason for that is because you've got things like insurances that come out of your super fund. So if you take out all of your money and the insurance direct debits stop, your insurances are gone. So please make sure you speak to the right financial planner, advisor, accountant to help you set up the self-managed super fund and make sure there's enough money left over to cover off any insurance payments that come through. So what we ended up doing is we ended up transferring $200,000 out of that industry super into their self-managed super fund. Then we went to a bank and we said to the bank that basically the client's got a combined income of $180,000. They've got 12.5% super contribution. So we are looking to basically utilize that in our servicing. So we're looking at $22,500 to buy a property. And also the property they're looking to buy is going to be a residential property, which we know, as Lillian mentioned, we're going to be using a 4% yield. So let's say they wanted to buy a property for around $800K. So at 4%, that was $32,000. So the total over here is $54,000 is the total contribution that they were looking for. The loan that they were looking for was 80%. So 800,000 times 0.8. So they were looking for a loan of $640,000. The interest rate on this loan was around 6.94% on principal and interest repayments. And the monthly repayment on this mortgage, I'm going to type that here. So monthly repayment on this mortgage was around $6,000 roughly. I'm just making up the round numbers. So $6,000 roughly every month is what they were paying on the mortgage. Now they already have the rent that's coming in and the contribution. So the actual income in their super fund every month was $4,541. So actually, I may not have done this correctly. Sorry, let me just have a quick look. So I'm going to do this at this times 1.5. So divided by 12. So this is the principal and interest repayments. So it's around $5,552 of monthly repayments, and they were only getting sort of $4,541. So straight away, the application doesn't actually work because the super contribution is lower and the rent is lower than what the current expenses are. So then we explored options of going down the path of additional contributions. So additional, untaxed. So we have got extra contributions available for both of these individuals. So we were able to use, we've got 22,500 for them. So we've actually got a space of around 60,000 minus 20,500. So they contributed an extra 37,500 into their super fund to help boost that borrowing borrowing capacity and the repayments. So that's how basically we were able to make that work. So
excuse me, Naveen. I just have a question here. Because in this scenario, you notice, there's not sufficient existing contribution, so it doesn't work, and then you suddenly put in another 37,500 as a once-off lump sum. The bank is going to consider that?
Yeah, so basically how it works, good question, Lillian. There's like a lot of different lenders that play within the SMSF space. So there are different things that they look at. So as a PAYG client and a self-employed client, you have the ability to contribute up to $30,000 each into your super fund, as long as you can confirm that you've got the capacity to do so. And how do you do that? You actually speak to your accountant. Your accountant will look at your current position and say, based on everything that I can see, I feel that you've got enough capacity to contribute more money into your super fund. And then we can technically use that for servicing. So the lender basically gives us a letter to say, this is a letter that the accountant needs to satisfy, and that letter basically covers to say, I am the accountant for the client and I understand this is what they are looking to do. Based on my assessment, they have the ability to contribute extra money into their super, and based on that we were able to make that work.
Oh, okay. Yeah, because I was wondering, there are lots of small businesses and self-employed people. Some years they don't contribute anything into the super. Yeah, so I'm just wondering if they already have they are super fund rich. They have money in the super, but they are not contributing regularly. Is there a way around that for them to be able to take out super fund home loans? So you just explained it, like, if the accountant can provide a letter to confirm they can afford this contribution, then, it can get them across the line. Yeah.
Yeah, so exactly right. So basically every individual client is different. Every situation is completely different, especially when it comes to self-managed super fund. But the one thing that stays consistent is the fact that you've got two contributions that you can work on. Number one is the standard untaxed contribution of $30,000. Number two is the taxed non-concessional $120,000 contribution every year that you can make. So total, you can make $150,000 combined. $30,000 is untaxed, $120,000 is after-tax dollars, right? So when we combine those, you can technically use that for serviceability and calculation. The lenders do want to see a history of super contribution. So it's not as though you've been self-employed for like 10 years and then all of a sudden you've done, or 5 years or whatever, but in the last 12 months you haven't put any money, and then you go to the lender and you say, hey, I promise I'm going to be putting $30,000 every year for the next 30 years for this loan. They're not too comfortable with that. You need to show some history of contributions within the last 12 months. We understand self-employed people don't necessarily pay put the full amount, we understand self-employed people technically sometimes pay a big lump sum of $10,000 or $15,000 in their super fund, which is fine. That makes perfect sense. You don't have to make contributions. You don't have to show that you make contributions at every pay. As long as you have a history of contributions, some lenders would be willing to consider that. But yeah, you have to have a history of the last 12 to 24 months of contributions before we apply for the loan,
Oh, wow. Okay. So for self-employed people who hasn't been regularly contributing, they may not qualify, and they can come see you to discuss, and then maybe you can tell them how much they should be contributing every month. And then after that, they need to wait about 12 months to build up that repayment history for you to do the loan, is it?
Yeah, so basically, I think the best starting point for them would be to speak to an accountant or a financial advisor to say that now I want to buy a property through super, and because I'm buying a property through super, I need to understand what my contributions are, right? So that would be the starting point, because if they haven't contributed in the past, this is something that they need advice on. And we can organize the finances. Our background is obviously organizing mortgage and finances through self-managed super fund, but we can't give advice on how much they can and can't contribute. So as a starting point, I think they need to understand whether they how much they actually need to, how much they can actually technically contribute. There are two kind of options, right? So generally speaking, someone can do something called a make-up super contribution. So let's say, for example, in the last 5 years, you've put in $10,000, right? So you've put in $10,000 over the last 5 years into your super. So you've put $50,000 over 5 years, right? However, you want to now do something called a make-up contribution. So in the make-up contribution, you can technically do $30,000 every year for the 5 years. So you can do $150,000. This is the untaxed component, okay? This is not after tax. So this is before tax contribution, right? So technically speaking, in the last 5 years, you could have put $30,000, but you only put $10,000. So what you can do is you can do a make-up contribution in which you could contribute an extra $100,000 in one go, straight away. And that could go into your super fund straight away. And then the lenders would be able to see that.
So if you do that, can you borrow straight away, or you still have to wait 12 months?
No, if you can show that you've got history of contribution, then that's fine. Like, I'll give you an example, Lillian, because I think that would probably be the best way. I had a client who wanted to buy a property. They had a import-export business. They wanted to buy a commercial property. They have got 2 commercial properties already outside of their super fund, one under trust and one under company. And then they wanted to buy a commercial property through their self-managed super fund. So they went to their accountant and they said that I want to buy this property. Can you set up my self-managed super fund, and we'll pay for it in cash? It's $3.2 million. We'll pay for it in cash. We'll get it done. The accountant said, well, hold on a second. You should look at getting financing for it, because it's going to be better for a tax point of view, because the tax rate in super fund is 15%, right? But if you have got no liabilities against your asset and only income coming in, then you're paying the full tax. So he thought ahead and said, speak to a broker, talk about SMSFs and see what you can actually get within your self-managed super fund. So what we did, they came to us, and what we did is we looked at their financials. Now, the client had not put any money into their super fund, I think, for the last 3 years. Prior to that, she was putting like $5,000 every year. So we spoke to the lender. We showed the lender, hey, Mr. Lender, the client is making a $6 million net profit every single year for the last 3 years. Here are the financials, okay? She's also paying herself minimum wage of $30,000 because she doesn't want to pay high levels of personal tax, and that's the accountant advice, right? So the lender then basically said, okay, well, the fact that she's making good income is great. The fact that it's an established business, it's great. The fact that they've got strong assets and outside of super, like they've got $12 million of assets and very little debt against them, it's all great. The one thing I'm not comfortable with is the fact that you have not made any super contributions in the last 3-4 years. So what we can do is, if you can show us that you have got the capacity to make that contribution moving forward, and you have contributed that money to your super fund, we can actually give you the finance. So we workshopped the application with the lender, and we were able to get them a loan of 80% on a commercial property, which is $2.56 million, that we were able to get on a commercial warehouse in Chullora, which is near the Canterbury Council area, I think it is. Chullora is an industrial area. We were able to get them a commercial warehouse there for $2.56 million. The beauty about this is, because they had a lot of money in their super fund, we set up an offset account. And in the offset account, they basically parked the exact money. So every month, their monthly repayments are going, but they're only paying the principal. They're not paying the interest. So they're technically getting the benefit across the whole process.
Oh, so super fund home loan can also have 100% offset or repayment offset accounts.
Yep, correct.
Oh, wow. Okay. So in the end, this client, they got over the line because they bought a commercial property with regular, rent, is it? And that made it.
Yeah, they were paying. So they were paying rent to themselves because they're renting it back to themselves. So they basically paid market rent of like 6%. But what we did is we showed the lender that outside of the 6%, individually, like personally, they had a very good asset position. So it's a very deal specific. Like every lender looks at it differently. Some lenders will say, okay, you've got very strong income, but you haven't contributed. I can't do the deal. Okay, I'm not able to do that. Some lenders will say, you've got very strong income, you haven't contributed, but I know that you have the ability to do that. Let's see what we can do to help you. Okay. And then some lenders will say, this is what we need in an accountant letter to provide us, to give us the comfort that we can actually obtain, that we can actually approve your loan. So there are different ways that lenders work. And like in the SMSF space, there's around 10 different lenders, and most of them have different policies, You've got some with offset, some without offset, but very lenient policy, some with a higher rate, with a more lenient policy. So we just have to make sure that we workshop every application before we submit it. So we haven't had any, touch wood, any SMSF loans that were submitted but that didn't get approved in the first go, because what we do is we get the client scenario, understand everything about them, then we speak to the lender and we workshop the deal to the very final minute. So with this scenario that I was mentioning, we pretty much had the loan approved even before we submitted the application, because we presented the application, we did the servicing, we workshop with the BDM, we workshop with the lender, we workshop with the credit managers, and basically said that this is how the deal is coming to you. Do you have any concerns? Is there anything that you want to raise to us before we submit the application? And they said, no, that's fine. We submitted it. The people knew what they were looking for because we already workshopped it, and it got approved in the first go.
Oh, understand. So in the case where, someone had to come up with 100,000 and they put that as a once-off lump sum payment, if they do that, is it possible one lender might say, okay, although you don't have 12 months history because you just made a huge lump sum contribution into the super, we will consider approving your loan. Is that possible? Or
yeah, absolutely.
Okay.
Yeah, they can look
Wonderful.
at it as a lump sum contribution, and they can potentially approve that on the basis that you have the capacity to contribute that every year moving forward. So
I see.
it's not just the one-off one lump sum payment of 100,000, and they're like, okay, that's fine. We'll use that $100,000 in servicing. We still need to look at outside of the super fund to see whether you have the capacity and prove that to the lender. If that is there, then yeah, that generally they're quite flexible to support that.
Sure. Got it. Very interesting. Thank you, Naveen.
Yeah, it's a very interesting space because self-managed super funds are actually probably the like, I guess not the easiest, but they're very straightforward. Like there's very little gray area. Like, can you make the contribution? Yes. Have you made the contributions? Yes or no? There's no middle ground. Like there's no kind of workshopping it to say, oh, what about, like it's kind of black and white. This is what you can do. This is what you can't do. You can't do $35,000. You can do $30,000 contribution. You can't do $130,000. You can do $120,000 contribution. Based on that, we can make it work.
Sure.
So another lender, Lillian, actually can use the full 150 as well for servicing, which is like there are so many options, and I think it's just about making sure we fit the right client with the right lender.
Yes.
Some client may not get the right loan approved with 100% offset, but some clients may get the right loan approved with no offset, but using the full contribution threshold.
Got it. I just wondering, because I chat to certain accountant people, they have very negative view about super fund home loan. They say, a lot of fees, very high interest rate, and it may turn stressful. Like you find yourself having to contribute into the super all the time to keep the asset going. Yeah, I'm just curious from because you've done many super fund home loan, like would you mind sort of sharing in your clients, right, what sort of asset they purchase tend to be most successful, don't have this cash flow and high cash flow stress problem? Like, is it more the maybe commercial property to have a strong cash flow so you don't go into this stressful situation? Or
so I think if we just go back for a second and talk about everything about self-managed super fund, I want to do a side-by-side comparison, okay? And
yes.
I'm going to try and do this correctly. So we've got your current super fund. Let's say it's $200,000, okay? And that's giving you a 6% return in best case scenario. So every year you're making $12,000, okay? Your industry super fund provider is charging you a management fee for your money. Generally, it's around 2 to 3%, but I'm going to use 2% here, okay? So you're paying $4,000 every year for someone to manage your money, to invest in shares that you have no idea what they're investing in, okay? Which is quite powerful in itself. It's your money for your retirement, and someone is actually investing in that. Sorry, I don't know what happened here. That was the link I was trying to share that. So you've got basically someone who is investing your $200,000 of super fund that your employer has been paying you, or you have been contributing to your super fund every year, into shares and investments that you've got no idea about, because technically you haven't really, you're not really following it to the T, right? And they're charging you $4,000 for it every year. So technically your fund, actually, I should say, is making $8,000 every year on $200,000 net investment, okay? So your return is around 4%, technically around 4%, okay? That's what you're currently making in your super fund, okay? Through your industry super. If you go down the path of SMSF, okay, we have to think about leverage here. Leverage is the most important aspect, okay? So leverage is basically you have got $200,000 and you buy an asset for, let's say, $750,000. So that's $750,000 asset. Let's say it grows less than the industry super. Let's say it grows at 5%, okay? So technically that asset is growing, and Lillian, you probably can correct me here because you're the expert. but technically that asset is growing around $37,000 every single year in growth, correct?
Mm-hmm.
Okay. The fees for a self-managed super fund to run the self-managed super fund is anywhere between sort of 2,200 to 4,400. So let's say 4,000 as well. I'm going to keep this the same. Okay. So that's the fee to actually manage the super fund, right? Now you've obviously got borrowing costs because it's not for free, right? So interest only on a $600,000 loan at 6%. Let's say 7%. Okay, at 7% is $42,000. Okay, so $42,000 is what you're paying in interest. Okay, then you've got rent coming in. Okay, so rent you said was around what do you say? 4%. So then you've got rent coming in of $30,000 there. So we have got, this is the this is the capital growth, $37,000. Okay. This is the interest expense.
Mm-hmm.
This is the rent. And let's say you're also contributing 30,000 because that's what you can contribution. So you've got a surplus here of this plus this minus this. So you're actually ahead by about $18,000. Okay, so $18,000 is your growth, and you've only put $200,000. You haven't put the full 750, right? Because it's loaned money. So 18,000 divided by 200,000, you're getting around 9% return on your money here. Okay.
Sorry, Naveen. This return of 0.09, has that also factored in the capital growth, or you haven't?
No, I haven't. That's what I mean. I haven't even factored the capital growth. That was going to be my next point. Is there's 37,500 of capital growth that you can factor in. What's the capital growth on $200,000 super fund sitting in your industry fund? What is the capital growth on that? We're talking $8,000 maybe, because that gets added on that. Or maybe the shares go up a little bit more in value, So, but there's nowhere near like sort of 5% growth, even if it was 5%, okay? So let's say if $200,000 sitting in the super fund is growing at 5% every year, that's $10,000, okay? Capital growth. So you're getting $10,000 capital growth here, and you're getting $37,500 of capital growth here. How much is your investment? It's exactly the same. It's $200,000, right? Does that make sense?
Yes. So leverage does win in this case.
Yeah, leverage definitely wins. And you've also got 4% return on this, and you've got 9% return on this, So, and the best thing about it is you're in control. So you find the property with Lillian can find you the right property, the right area that's going to grow, that's going to give you the rental income. You are in control. You decide whether you want to buy that property or not. Currently, you can choose between strategies of high growth, low growth, standard with your super fund, and they will find an index fund and they will invest in it. But on the other hand, you're in control. So not only do you get good return on your money, you get maybe worst case scenario 5% better, but you also get capital growth, and you're also in control of your investment. Now, this isn't financial advice because I'm not a financial planner or an accountant or anyone capable to give that advice. I'm only sharing my own personal circumstance. I set up a self-managed super fund. We bought a property in Queensland, and I bought that property for $535,000 in 2023. So we're just 3 years in, and I've been receiving offers. Agents are trying to get me to sell for around $790,000, and that's in 3 years, right? So we have grown my property value, my asset, my capital has grown by $255,000 inside my super fund. Would I be able to get this growth if my money was in the share market? Very highly unlikely, in my opinion. And that's why I feel super funds are a really good option for the right clients, but they have to get the right advice. Speak to the accountant, financial advisor, talk about the overall risk tolerance, do a proper assessment before they can actually consider it. But if you haven't considered it, I think that's that's something that people should be looking for.
Great, thank you. Yeah, now that you put it side by side and compare the cost and the earning, it's not so bad. Yeah.
Yeah, and I think that's the that's like, I mean, for someone who's thinking about this and they don't know what they're looking to do, they don't even know if it's the right thing to do. This is where you start, right? You go into your super fund, you look at your current balance. How much have you actually got? You know, can you answer that question off the top of your head? Most people know how much they get paid. Most people know how much their credit card limits are or what they spend on things. But do you know what your super fund balance is? Because it's your money at the end of the day. It's not someone else's money. It's your own money. So do you know how much it is? Do you know what it's currently invested in? Do you just like have a look? Is it high growth, low growth? What shares is your super fund buying? Is it buying Commonwealth Bank, ANZ Bank? Is it buying Nvidia shares? Is it buying gold, silver? What is it buying? It's your money. You need to know about it, right? What is the return? Like, how much are you actually getting back on your fund? What is the actual return that you're receiving on your super? Is it 5%, 6%, 4%, 3%? Get an idea. Know how much you've made on it. How much is it actually costing you? How much is your fund manager charging you to give you those returns every year? The higher the super balance, the more the costs. So it's not the other way around. Like if you've got high super balance, if you've got 300,000, 400,000, 500,000, it's a 3% charge. And every time it goes up, it goes higher. So these are the most important questions people should ask themselves is this something that I'm aware of? Because it's my money, you know? And then once you know that, then you can speak to an accountant, speak to a mortgage broker. You know, we can help you paint out the picture to understand what the options are, and then, you know, give you a proper black and white on what we can do.
Sure, thank you. This is very helpful.
Yeah. And I think that's definitely something that we can explore. So moving on to the next part. Any other questions there, Lillian? Anything else that's come up?
No. Yeah, about 5 members is watching, and one member just say, "Can you make the Excel spreadsheet bigger?" But I done it already, so that's fine.
Okay, fair enough. Sorry, I think yeah, it's high level numbers. Like I don't think people should really be deep diving into this and saying that this is the wrong number, right number. It's more about the actual concept and the principle to look at exactly what are the options available. That's the most important thing, in my opinion.
Excellent. Great.
Alrighty, so I've got another a couple more things that we wanted to talk about today.
Yes.
So the second one, like lately, like after the federal budget has basically finished, well, they've announced those changes. A lot of people have been asking me about buying commercial property. Is it the right thing to do? So I think I'm going to throw over to you, Lillian. What do you think? Like, I mean, you're obviously in the space yourself, you know, you're seeing a lot of properties hit the market now with the rates being where they are with the federal budget announcement. What do you think? Like, do you think commercial or residential? What is what like, you know, if someone was to ask you what should I invest in, what would be your thoughts?
I'm more a residential buyer supporter because commercial has its risk. Yeah, it looks great, like, oh, net income is higher than residential. Yeah, but you know, tenant can, you don't know, right now is great. Suddenly, you know, they disappear or their business folded. Yeah, and then to replace that tenant, it's a lot longer than residential. You know, residential, you might drop like $20 or something and you get a tenant in 2 weeks time. But commercial, it can take months, you know, so you got to have that. So I think it's good for people who's already got, you know, a number of residential properties, you know, and they have strong cash flow. You know, they can prepare for the, you know, sudden unexpected situation in commercial property. To move into the commercial space. But you know, with more and more business going online, you really wonder, you know, like commercial property.
And I think that's a very good point, because commercial is definitely you need to do a lot more due diligence. You know, in Australia, if you buy a property with a bit of land, kind of mostly anywhere, like, I mean, within reason, it's likely to grow, you know. And if you buy a commercial asset, you need to do like a proper check in terms of what the tenant like what are the uses that like what's the demand, what are the infrastructure, but a lot more in detail, like has the commercial property been serviced, has the air conditioning been serviced, has the has it met the certain standards, all that sort of stuff. So it requires a lot more detailed analysis and a lot more due diligence. Generally, what we're seeing at the moment, Lillian, is people that have got 3, 4, 5 investment properties that are residential, they're now turning to commercial because obviously they're negative, right? So what they're looking to do is they're looking at the current budget, and they're looking to find out what is actually possible. So on the basis of that, they're turning to more kind of the commercial aspect of things. So I can briefly touch on what commercial lending looks like for customers, and what people look for when they are doing a commercial loan, and what banks generally look for. So there are mostly in commercial lending, there are 2 types of loans. One of them is called a lease doc loan, and the other one's called a full doc loan. In a lease doc loan, your income or your loan is purely based on the tenancy, the tenant. How strong is the tenant? Are they able to make the loan repayments? How long is the loan? How long is the tenancy? Is it 3 times 3 times 3, 5 times 5 times 5? All those sort of things matter, right? They also look at how much is the rental yield. Okay, so the rental yield is the most important aspect when it comes to lease doc loans. They also look at the asset class. Is it a standard commercial? Is it a shop front? Is it a retail shop? Is it is it like a proper warehouse, industrial, semi-industrial shop with a accommodation at the back? Those kind of things. That's what they look for. Those are the 3 main things, right? That they look for in the lease doc loans, and the rates in this space start for around 6.9% to maybe 7.1%. So it's fairly decent. The other thing they look at is something called a interest cover ratio, ICR. Okay, so how this works in lease doc is if you're getting, let's say you buy a commercial property for $1 million. So firstly, let me talk to you about LVR in the commercial. So the maximum LVR in lease doc is between 55 to 65%. Okay, so it's a lot less than what you get in standard residential. Residential is around 80%. This one is 55 to 65 under lease doc. And then basically, let's say for example, you buy a property for $1 million, a commercial asset for $1 million, and you get a 55% LVR on it. That's a loan of $550,000. The interest rate is 6.9%. So your annual interest repayments is $550,000 times 6.9%. So $37,950 is the annual interest cost. Okay. What the lenders would look for is basically the rent that you're receiving from this business, from this asset, is equal to 1.5 times. Okay, so it has to be 1.5 times, so 1.25 to 1.5 times. Okay, so in this instance, if your rent is this times 1.5, if your rent is around $57,000, that's it. They don't need to look at anything else. Okay, tenancy, rental yield, asset class, and interest cover ratio. That's it. And then the loan gets approved, basically. Fairly simple, right? Normally, people buy commercial assets under company names or trust, not under personal names. And you need to speak to your accountant whether that's the right thing for you. But that's pretty much it. So it's 1.5 times of the rental income that you're receiving is... 1.5 times of the mortgage repayment is what the rent needs to be or higher for the lease doc to work. If it's lower than this, then we might need to basically either look for other lenders that have a lower interest cover measure, or you need to increase rent.
Can I ask, if you buy that in super, will the 35% deposit plus the stamp duty costs come out from super, or you need to pay the stamp duty separately for cash?
It's all through super.
All through
when
super.
You buy property through super, all your expenses come through super. The 0.5% deposit, the valuation fee, everything has to come through your super fund because it's the super fund that's buying it. You don't want to use your own money to buy a property through super. It has to be your super fund money, which is a separate entity. It's not you, it's your super fund. So everything has to be coming from there.
Okay, thank you.
Now, the one good thing about this lease stock arrangement is, let's say, for example, Lillian, you've got clients that have got 4 properties, investment properties, right? And now they're looking to buy a commercial property. They've got lots of equity built up already in their residential property. What we can do is we can extract the equity from their residential property, okay? And let's say, for example, they can get $500,000 out from their investment properties. We could use that $500,000 to cover the remaining to make this purchase happen. Does that make sense?
I didn't quite follow.
Okay.
Did you mind saying one more time? Thank you.
Yeah, sure. So let's take this example here, right? So we've got this client who's got a market value here of 1.5 and 850K here. So technically, their max LVR across this is 80%, right?
Yep.
So what we can do is we can do so technically max loan against this would be equal to this times this. So that's 1,200,000. This times this. So the maximum they could get is $1.8 million, 1.88, okay? But their current loan is equal to, is equal to 1.18, okay? So what we could do is we could take out equity from these properties, okay?
Yeah.
With a normal residential bank, normal residential lender, and get around $700,000 cash out of the property, okay? That $700,000 could then technically go into the company that's buying the property, like the commercial property, and that $700,000 could form as part of the contribution into this super fund, into this investment. Does that make sense?
Yes.
Yeah. So that's where lease stock work really well, because in lease stock, the bank doesn't care about any of this. Okay.
Yeah.
They don't care about this. They don't care about your credit cards, your car loans, all of that. They don't care. As long as the rent can cover 1.5 times of the interest cost or more, then the bank is happy. Now you just need to contribute more money towards this part, you know?
Yes. I'm curious to see the full doc side.
Yeah. Yeah, full doc is also a very popular option actually, because in full doc, what people can do is they can use a normal assessment. Okay, so in this instance, it's just the same as a home loan, except we use a higher yield. Okay, and the rates are higher. So in this instance, it's around 7.9% rate as a starting. Could go higher than that, depending on the security value, depending on everything. This one can be a 30-year loan term. Okay, on the lease stock, the loan term is only as long as the tenancy is. So if the tenancy is 3 times 3 times 3, which means that you get a 3-year loan, and 3 years later, the bank does a review, and then until you get a second tenant, they keep checking in to see how everything is going. But as long as you're paying your mortgage on time, they don't care, right? But it's a 3-year loan term, okay? Whereas in this time, it's a 30-year loan term, okay?
Yes.
Obviously, rental yield is still important here. You're looking at around 5.5% to maybe 7.5%, depending on the asset. And the asset class is important as well, okay?
That's net or gross?
Commercial leases generally are net, because the tenant pays the outgoing. So if you have a commercial warehouse that's leased out to a car mechanic, for example, the mechanic pays electricity, water, everything. You know, you just get a net rental yield come to you. That's it. You don't pay for ongoing maintenance and things like that. Whereas in residential, that's the difference. Is in residential you do pay your water, as well as
council rate,
maintenance, council rates, all that. Yeah. So that's the main point of difference there. And in this one, the bank can go up to 80%. maximum. Okay,
Yeah.
LVR.
Yeah.
Maximum LVR is 80%. Okay, which means 20% plus cost. Generally, a commercial asset costs you around 5% to buy. Okay, so if you buy something for $1 million, it's actually going to cost you $1,050,000 to actually complete the purchase. Okay, so you need 80% against this commercial asset plus 20% from your assets here. Okay.
Yeah.
So on $1 million property, maybe the bank can give you a loan of 800,000. You still need 250K to complete the purchase because you need to pay stamp duty, legals, GST, all of that sort of stuff. So that's where you can cover these the shortfall. You know,
seems like this one is more suitable for people who doesn't have like, so much like 35% plus stamp duty cost. They need more deposit.
Yeah, I find where possible, right? Where possible, the lowest LVR, because obviously these rates are higher than standard residential. You know what I mean?
Yes.
As you can see, these rates are higher than standard residential. So the way I look at it, in my personal opinion, is that if I have got equity built up here in my properties and I can keep my LVR lower and get a cheaper rate from the bank, I want to do that. You know, because if my rental yield is $57,000 and my mortgage is $37,000, I'm technically making $20,000 of income on that asset. You know what I mean? And I'm also borrowing money from a cheaper source of fund from from here to to make my overall costs minimal. Does that make sense?
Makes sense. Yeah. So you mean, borrow the difference from residential home loan and put that towards lease stock and enjoy a lower interest rate. Okay.
And use that income that you're making to technically help pay down your mortgage, your principal place of residence, you know?
Very interesting. Okay.
Yeah. Commercial is definitely becoming very popular, but you have to be careful with commercial because, like you said, some of the risks are the actual tenants. Like, so once a tenant leaves, it could take you anywhere between 6 to 18 months to find another tenant. Okay.
Yeah.
That's a risk you have to be willing to take. Okay. Because you still have to make your mortgage repayments. That's not going to stop because you don't have a tenant. Okay. That's a big consideration to think about.
Yes, that's why some clients, like, for the amount of risk I'm going to take on, is it really worth it? Like, sure, I want higher rental return, but it's not like a lot higher than residential anyway. But then I have to take on more risk. Yeah, and then they weigh it up. They're like, should I really go into commercial for that risk just to get a little bit higher rental return?
Yeah. Put it this way, right? Like, let's say, for example, you're getting, say, let's use this example. You've got $57,000 of rent. Your interest is $37,000. Every year you're making $20,000. For 3 years, you've made $60,000 profit, okay? Then all of a sudden your tenant leaves, okay? And you don't find a tenant for, let's say, 1.5 years. Let's say 18 months, no tenant, okay? You still have to make your mortgage repayments of 3,975 times 1.5. Okay, so your 1.5 years of mortgage is $57,000 that you have to pay, but you're ahead by $60,000. So you're still somewhat safe in that way, but it's like you need to weigh up all of these things. I've seen clients that come to us and like I was speaking to someone yesterday, they're rent vesting and they're buying investment property, but they're only buying commercial. So their first property was commercial. Now they're buying another commercial, and that's what they want to do because that's the strategy that works with them. They're on good income. They don't really have a cash flow issue. They just want to buy assets and pay more money to themselves, pay the tax or whatever. That's up to them. But most of the times I see clients with 5 investment properties, 4 or 5 investment properties looking to get into a diversification. They want to change their risk from residential to then go into commercial purely because they want to get a cash flow component. Also, the federal budget announcement that, the taxation changes that are proposed, all of this coming into play. People are looking at commercial, but these are your experienced investors that have done their residential part already. They've said multiple properties and they want to look at commercial, or, someone who wants to sort of diversify really.
Yes. Yeah, very interesting. Thank you, Naveen. Yeah, learn heaps from you. I can tell you are very professional. Yeah.
Thank you. I appreciate it. We have done a lot of SMSF and commercial loans. So if you were to buy a property through your super fund, which is a commercial, that's again an option, but we have to keep in mind the rates are closer to 8% in the commercial
Yes,
space.
this is yeah, like I don't know, Australian interest rate, home loan interest rate is very brutal. Yeah, in
It's
Taiwan
getting like
it's
that. Yeah.
like 2-3% lower. Yeah.
Yeah.
Wish we have
Yeah.
lower interest rate.
Hopefully soon that will be, maybe next year. So what, I mean, as we already know, they're predicting, no more, like no more interest rate rise for next month, maybe.
Yeah.
And then they're just government, the RBA wants to see what happens, because the whole idea of raising interest rates is because the property prices keeps going crazy. But after the federal budget, it looks like it's starting to take a different direction. So they just want to wait and see. So maybe no more rate increase this next month, and maybe month after or something like that. But this is the true environment that we're in. But SMSF commercial loans are definitely more expensive than standard commercial loans, because SMSF commercial loans are not available through the normal bank lender. You have to look at the non-conforming lenders.
Oh, so
and
all
they
the
do
major
charge.
banks don't offer.
They don't do SMSF loans.
Oh, okay, sure.
Yeah, you can't go to ANZ, Westpac, CBA, Macquarie, Bankwest, any of these guys to get an SMSF loan. You have to go to some of the non-conforming lenders like Pepper Money, Granite Home
Yes.
Loans.
Yes.
These are probably some of the options that you've got available to work with, and that's what we go down the path of.
I wonder why the major banks don't want to do it. Is it because too time consuming, or they feel it's too much risk, or what?
Yeah, I think
It might change now that the new budget seems to be, creating more interest towards this direction. I don't know. I'm just curious what you think why the major banks don't do it.
See, when I was working at Westpac in 2014, I used to do a lot of SMSF loans. I used to do 2 or 3 SMSF loans a week. And then I think around 2016, 2017, they withdrew from that space, and they no longer offer the SMSF loan. So they only offer the standard residential mortgages and all of that sort of stuff. So that was their main source. I feel it's got something to do with maybe the risk and the compliance. The compliance is very, very brutal in SMSF. So especially for a major bank, and the other thing is, like, with the property market being so volatile, sometimes people can buy assets that are not necessarily the best for their super fund, and that can cause an issue, Now, with SMSF, how it works, right, is basically you've got 2 different entities. One of them, so when you go to the bank and you want to get a loan, the bank says, okay, give me your SMSF. So it's going to be like, let's say, for example, ABC Proprietary Limited as trustee for ABC Super Fund. Okay, this is the entity that borrows the money from the bank. Okay, and the property holding is under ABC. So let's call it EFG Pty Ltd as trustee for property number 1 Bear Trust. Okay, so as you can see, the property is actually owned by the property holding company, and the loan is against the super fund. Okay, what happens if you can't pay your mortgage? Okay, and you need to, and the bank tries to find ways to help you, but you can't pay it. There's no tenants. You're not able to successfully pay it. Okay. If you have a normal home loan or a normal commercial loan, the bank would take over the property, sell the property, pay themselves back, then come to you for you to pay back collection costs, any differences that you need to pay. For example, you buy a property for $1 million, you get a loan for $800,000. The bank tries to make you pay that loan, but you can't pay it, and they sell the property. They only get $750,000. Okay, they will come to you for $50,000 plus collection fees and all of that, maybe $150,000 for damages or whatever, right, for collection. and they will come to you for you, look at you personally, look at your house, look at your cars, look at all your assets, and try and get their money back. Okay, they basically sell that debt to a collection agency who will go and do that. Okay, in SMSF, none of that happens. SMSF is something called a limited recourse borrowing arrangement, LRBA. So what that means is if you get a property through super fund, same thing happens. You buy for $1 million, you get a loan of 800,000, and you can't pay the loan. The bank will ask you for the money back, and you can't pay it. The bank will take the property and sell it in the market, and they will get $750,000. Okay, that's it. They can't come to you personally for the rest of the money. They can't go to your super fund for the rest of the money. They've basically only been able to collect from the property itself. That's why there's a separation of ownership between who owns the debt and who owns the property. So if something happens, the bank can only go up to the property and sell the property and get themselves paid back. And this is probably one of the reasons why the major banks got out of it, because the risk aspect of it is the fact that if you have to foreclose to sell an asset, you can't go for anything outside of that asset itself, which is a bit of a higher risk for them, you know?
Yes, I agree. Very interesting. Thank you, Naveen.
Yeah, no problem. That's fine. And I think that's the two, commercial and SMSF. And I think the final part of our conversation was around how people can navigate through the high interest environment, you know?
Yes.
We see this time and time again. Like, people have got obviously assets that have been built up. They lock themselves at like 1.5, 2% interest rate during the COVID period, and now the rates are like 7%, you know, 6%. So it's a lot higher, and the rental yields are lower, you know. The way that I see it is, like, technically speaking, any properties that are investment properties, you should look at options of putting them on interest only, you know. Some banks, let's say, for example, you hold, I'm going to delete this so it's not confusing. I'll just focus on the next topic, okay? So let's say delete, no fill. Okay. Oh, sorry. So I'm going to delete that as well. Okay, so let's say, for example, you've got a investment property for $1 million. The loan is 800,000, and you have got it on principal and interest repayments at the moment, and you're paying the principal and interest off. Or your interest-only period is expiring, and it's going to go on P&I, you know, and the rent is not that strong, and you're not continuously able to make mortgage repayments. You should look at ways on how you can put that on interest only. Again, generally, if you've held a property for more than 12 months, a lender will allow you to refinance that property over to them, as long as you have made mortgage repayments on time, not missed any payments, have a good credit score, and they will use a 1% buffer instead of a 3% buffer. So let's say, for example, if the rate is 6%, okay? At a 1% buffer, the bank assesses you at 7%. At a 3% buffer, the bank assesses you at 9%. So that is a difference of 2% in the buffer rate, which is a big difference, okay? So currently there are two lenders in the market that actually allow you to refinance your loan from principal and interest to interest only at a 1% buffer and reduce your mortgage repayments.
Oh, okay.
Yep.
How do you reduce your? Oh, sorry. You mean I thought you mean reduce the balance. You mean reduce the repayment? Okay.
Yeah. So I think the only way to reduce your balance is by paying more into your loan. You know. And actually physically reducing the balance. There's technically no way that you could reduce your investment property debt. You know. You have to pay the loan off. Realistically, instead of paying monthly, you can pay weekly, so you pay more money more often, and interest charges go down. But realistically, the only way that you can reduce your loan balance is by paying the loan off. You know, technically that's the only way. There is another way called debt recycling. Have you heard of that? Have you done that before?
Yes, I heard of debt recycling. Yeah, but I don't really do it.
Yeah. So I think debt recycling is something that you can speak to your accountant about and see if that's something that work for you. Okay. So in this example, our client has a property for $1.5 million and a loan of 500,000. Okay. And I think this is, again, probably not the right time to talk about this because the budget proposal is in place and this can change. So maybe speak to your accountant and figure out if debt recycling is still an option. But I think that if the budget goes through, then this is gone, you know. So the only thing that you can really look at is interest-only repayments on your mortgage, on your investment property, to reduce the monthly commitment, realistically.
Are you getting much borrowers that come to you and say, the interest rate is too high right now? I want, I don't know, interest only for 5 years on all my loans, principal, a home, residential or investment. And what do you think about that?
Yeah, so I give you an example. I had a client that came to me. He had 4 investment property, and I'm just going to try and remember the scenario. He had 4 investment properties. They were all with different banks. I think one was with Adelaide Bank, one was with BOQ, one with ANZ, and I think another one with ANZ. So 2 ANZ, 1 BOQ, 1 Adelaide. Okay, and these were all on P&I repayments. Okay, across all of them. Okay, and their home loan, they didn't have any debt on the home loan, right? So their home loan had 0 debt. Okay, and they wanted to put this mortgage, all of these loans, on interest only again. So I think totally there was 430 plus 510 plus 650, and then here was around 350. So this was the total debt. So their total borrowing was around 1.94 mil. That's what they were currently working with. Okay. So this was their actual position, right? So they wanted to find a way on how they could reduce their monthly commitment. They were going from principal and interest they wanted to go from principal and interest to interest only. Now, what we did is we went to one single bank, okay? One lender, and we were able to refinance all of their loans on interest only, okay? And what we were able to do here is we were able to get them, once we got them on interest only, we were able to fix the loan for 2 years, okay? Across all of their loans. So we had 2 years fixed on all their loans, and we were able to get them, I think, 5.89%, 5.89% fixed for 2 years across their whole portfolio. So now, for 2 years, they don't have to worry what happens in the market. So I think the most important things that people should do is if they have a loan, right, they should review it every 6 months, because what happens is banks go through cycles. So in 12 months, 2 months, one bank will have an amazing offer. All the clients want to get the best rate. This bank wants to take all the business because they want to get the best possible result for them. Okay, so they've got an amazing offer. Month 3 and 4, let's call it, April. Let's call it March, April. In March, April, bank number 2 will have an amazing offer and a cashback. They want to get all the loans, and then once month number 4 is finished, they don't really have any more appetite. They're happy to just keep on going through the year now. They don't really have that much of a hunger, So the reality is that you should check every 6 to 12 months to make sure that you've got the best possible product, the best possible rate in the market. And we don't necessarily tell everyone to refinance, because there's costs to refinance. You have to pay a discharge fee, you have to pay a registration fee, you have to pay some other costs as well on top. So it could be around $1,000 to discharge and re-register a mortgage. So we don't tell everyone to do that. We actually say, this is the current market offering. Let's say one bank is offering 0.3% cheaper than what you're currently on. Go talk to your bank first and tell them that I am getting this rate from this bank. If you can't match it, I'm going to leave. Okay? Then they'll say, oh, let me see what I can do. Maybe they can't give you 0.3, maybe they'll give you 0.2 better. It's still better than what you're currently on, and it's still better than refinancing because you didn't pay the discharge fee, you didn't pay the registration fee, and you're on a better rate.
You're right. But I just want to share my own experience when I negotiate with them. They say, oh, it's a broker loan. We don't have much discretion for that. And
Yeah.
then they do not, like, they decline to give me any discount until, already done a refinance with a broker and already faxed through the discharge form. Then they ring up at that point. And at that point, they are willing to do anything. But at that point, it's like too late. So I don't know what's wrong with the bank's mindset.
Yeah, so sometimes like they just want to try and push the envelope to see how far you will go, but the reality is that's the way the banks work. So I always tell my clients that come to me for refinancing is before we even start the process, let's fill out a discharge form and let's submit the discharge form to the bank and let's see what they do. If they're going to try and retain you, great, we can try and get you a better rate and keep you with the same bank, no problem. If they don't do anything, then we'll refinance you and we'll look at a better option, for you.
Fantastic. That's a great idea, Naveen.
Yeah. Always start with the discharge first, Lillian, and then see what they can do. If they can give you a better rate just to stay with them because you sent a discharge form, then you win, But if they can't, then
you are bluffing, so they don't take you seriously.
Exactly. You have to show them your intention on paper. Send them the discharge.
Yes.
It's unfortunate that we live in a world where you've got people that are paying interest on time and doing the right thing, but their lenders may not be looking after them in the best way.
Exactly. I find like they do not value long-term customers.
Yeah.
They extend the special to new clients. And they don't reward for loyalty.
There's no reward for loyalty. Yeah. There is zero.
Yeah.
Yeah, there is zero reward for loyalty. I think you have to always check with your lender, with your broker, and that's why brokers are the best people to work with, in my opinion. And obviously, this is, I've got a hidden agenda because I'm a mortgage broker, but I've worked in a bank before for 20 years, and I understand how banks work inside the system, and I know what they look for and what's important to them. A mortgage broker, they don't charge you any money. Most of them don't. They work for you, they get the loan approved, and the bank will pay them, right?
Yes.
They don't actually charge you any money. Every 6 months, they review, like we every 6 months review your loan with your bank to make sure that you're still on the best rate and try to negotiate with them. And that happens automatically in our system. Like we'll get a notification. We've got team members that will go into your profile and see, you've got a $1 million loan. You're currently paying 0.2% higher than what we got for another client 2 weeks ago. Let's try and negotiate a better rate with your bank. And we also check your equity position to see if you've got more equity. If you want to look to buy another property, there's options there. We can look at your repayments and see if we can put you, if you're looking to go interest only on your investment property, we'll give you options on that. So that's what we do. We do ongoing reviews, and that's why we get paid from the bank to make sure that we looked after you. We look after you, So whereas a bank has a different agenda. A broker can sell 30 products from 30 lenders with 30 different options and 30 different rates and 30 different repayments and all of those sort of things. A bank can only sell one product and one repayment and one rate and one particular thing that fits in their category, So I think this is why more and more people, I think there's around 80 or 85% of people that are looking to get a mortgage go to a mortgage broker now, because we have got access to the property, to the lenders. We work all the time. Like I'm always working. I was talking to someone at 1:30 last night a.m. in the morning.
Wow.
On WhatsApp, just chatting on their loan because they had some questions. So
you work too hard, Naveen. 1:30 a.m. You beat me.
It's just like a lot of people have queries and inquiries about what's happening in the market. So we're available, and that's what we have to do. We have to be available for our clients when they need us, and that's why we run the business. So yeah.
Yes. I what I like about broker the most is before even going to the banks, the broker will take time to set up a great package, a great scenario for you before present to the bank.
Yeah, exactly. And I think that's the main point, is that we can I don't know if I'm sharing screen anymore. I'll just stop that for a second.
Yeah, I don't know, we are running out of time or something, so we need to wrap up soon.
No, that's okay. Look, I mean, definitely, I always encourage people to speak to their broker if they're looking for finance, and if they're looking for anything that is non-standard, substandard. Definitely speak of different lending options. But this was great. I really loved doing this, and it was on the fly. I wasn't like as prepared as I'd like to be, but I think I hopefully was able to add value to your audience, Lillian.
Oh,
and
definitely. Naveen, I learned so much from you. Yeah, sometimes I worry, you invite someone and they just talk about things that's quite basic and the member already know. So it's not as stimulating and people cannot walk away with more knowledge. But today, yeah, you have demonstrated, I learned a lot of new things from you. I really appreciate. And
likewise,
I'm sure
and
the
I appreciate
member
it.
will also.
Yeah, likewise, I appreciate it. And look, like I said, not everyone's scenario is the same. Everyone has got a different scenario, different goal, different expectation, and that's where we can help plan out that process together. Lillian and I can work together and get that done. So yeah.
Fantastic. Yeah, so members, if you have questions or would like to review your loans, I think Naveen have demonstrated today. He's very helpful and very knowledgeable. Yeah, so please contact him for any further inquiries.
Thank you. Thank you. Thank you, everyone, for joining. Thank you, Lillian, for having me on. It's been a pleasure.
Yes, definitely. Thank you. And thank you for your time. 1.5 hours.
Now it's time for lunch.
Yes, time flies when you are, learning heaps. Yeah.
100%. I really enjoyed this. Thank you so much.
Fantastic. Thank you. Bye for now, Naveen.
Bye-bye. See ya.
See ya.